The Raffles Crew is about caring for ourselves, caring for our careers, and caring for our planet. That includes a bunch of different things. But whether you're looking after yourself or looking after your career, it's very important that you know about what's going on in the region. We think that whatever industry you're in, even if you're between things, it's important to be able to have conversations about what's going on, particularly in the key geographies around the region. The things that the Raffles Crew does, we do regular coffees now, not just in Singapore now, but in KL as well. We have signature networking events. Our signature event is KOTU, Center of the Universe. A number of you were at the first one. We have a second one on the 23rd of June. That's pretty close. That's going to be great. And I'm going to talk about that in a minute. We also have a whole range of panels. So we started having panels on all sorts of different subjects, and we're kind of building that up. Yeah. So the next Seekers, Founders, Funders. Why Seekers, Founders, Funders? Seekers are that constituency who are would rather be doing something else than what they're currently doing, which is a surprising number of people in middle age, or have found themselves inadvertently out of work. I reckon that of the 300 members of Raffles Crew, about 25% fall into that category. So we're committed to welcoming them and helping them through that period of transition, because we're also very, very full of founders and funders, particularly of entrepreneurs. So there's opportunities for people to work in different areas. Yeah. And the event on the 23rd is about communication and color, because whatever space you're in, you have to be able to put your point of view across. And we've got three absolutely brilliant speakers doing 3 mini workshops. You get to choose which workshop you want to do. So far, I have to say about 40 plus people have signed up, and the choices are pretty well evenly spread. So QR code to my right at the top, for those of you who haven't actually joined the event on the 23rd, do think about clicking on it. Without further ado, I'm going to welcome the wonderful Gary Dugan. Gary.
Thank you very much, Simon, and it's a pleasure to be contributing to this. I did enjoy my time in Singapore when I was living there on 2 occasions. Unfortunately, the last one was in COVID, so I wasn't enjoying the networking, which was only with my wife and my son. But yeah, let's talk Asia. But I'm just going to start with some very brief thoughts about the context, the global context we find ourselves in. I think if you went back some months ago, it was like everyone was negative. Everything was going wrong in the world. But what has emerged is that we don't live in a static world. We live in a dynamic world, and where one thing happens, you get a reaction. And I think what I would say, I'm pleasantly surprised with the positive reaction that I've seen in Asia and indeed even in Europe, where countries are finally moving away from looking for leadership from the United States, assuming it's not going to be there, and are moving on and creating things within their own domains. And we have seen some significant political change, I think, in Asia in particular, but even in Europe, you could never have imagined that the Germans would be spending lots of money. Before, they were principally saving it and forever trying to reduce their budget deficit. A war, of course, may have changed that, but I think there's a much more positive attitude outside of the United States, and that's what I find a lot of my investors interested in. So let me just start with one real positive, which was surprising when I went through some of the kind of data points that I look at. Asia at the moment is that part of the world where the economic data is coming in mostly above expectations. There's some days where you look at the numbers, you're going, oh, that's about in line. But there's a positive feel. Now, part of that may be just this kind of front loading of sales that are going on to the United States ahead of the imposition of tariffs, for sure. But it doesn't matter.
Oh, Gary froze.
We have a region at the moment that clearly is going to have its challenges if these tariffs come to pass at the kind of levels that were set out. But we are going to see, I think, consistent policy making in support of each economy. So when I go through this country by country, it's about, are the governments spending money? Are they supportive of confidence? Is the central bank in a position to cut interest rates? Is there a currency crisis just around the corner? Very unlikely given the weakness of the dollar. So let me just start with the headlines. In Asia, we are looking for growth rates of around about, I would say, 3.5% to 4%. I think it's going to be closer to 3.5 than the 4. Again, that might sound a modest number in the context of what we may have enjoyed over the last 10 or 15 years, but in the context of the challenges at hand, I believe that's a good number. Again, a lot of it is front loaded. And as we go into the second half of this year, we will see maybe a marked step down in the rate of quarterly growth because a lot of products has been sent out to the US and other parts of the world where those tariffs were going to cause some damage. Inflation is a problem for the United States. Tariffs are a problem for inflation in the United States. Elsewhere in the world, Asia included, we are not going to see a material increase in inflation to worry policymakers. So we have numbers in our mind of around 1.5 to 2% as a kind of average inflation rate across Asia. To be fair, that is dragged down by what are near deflationary-like conditions in China. So let me just turn to China. And I would say that if there's one country out there that we perhaps seem even more surprised, it has been China. Now, the country is still likely to be only growing at around the 4% level rather than the 5% that the government's targeting. But with the government having a target of 5%, and it seemingly that might come out at 4.5, they will be on the front foot, we think, in terms of continuing to support the economy. And although confidence has dipped a little bit in the industrial sector as they've worried about tariffs, this is no cratering of the Chinese economy. Indeed, as we've heard, and I think I would have to say mostly focused on the first and second tier cities, consumer confidence is showing signs of improvement. The government's literally giving money away. I talked to a friend in Shanghai, when you get to pay your bill for your meal, they take 25% off. Thank you very much, the president. It's these kind of things which are just giving a little bit of a bubble of confidence and are certainly improving. And the second thing is, one of the most notable things of the last few months has been signs that of people doing business with China. And that was very, very clear in the pharmaceutical sector, where people, they saw the DeepSeek moment. They saw that BYD is outselling Teslas. And now we get in the pharmaceutical sector another feel-good story where international companies want to be engaging with Chinese companies and are not seeing them as the competition, but as a credible part of the world that they want to do business with. So I think there's almost been a mindset change in regards of international perception of China, and also within China, the stabilization and modest improvement, although from a low base. I then turn to India. And India, everyone wants India to do more, but India growth rate is still going to be one of the most, vibrant numbers that we're going to see around. We're looking at GDP numbers of 6.5, and people say, "Well, I remember the days of 7.5." He said, "Well, just calm down. 6.5 in this kind of environment is good." Modi is playing a relatively cute game on tariffs. The central bank is cutting interest rates. The level of 10-year yields and 2-year note yields are some of the lowest we've seen in some considerable time. You've got financial stability. You've got relatively reasonable good growth of confidence. You haven't got that strong stimulus that's going to give you a big surprise, but you have seen 50 basis points off interest rates recently that have not done damage to the currency. The currency is relatively stable against what has been a weak dollar. And we think that if we do get, a lot of people are hoping for, a good monsoon season, but the benefit of 50 basis points off interest rates in an economy that is desperately short of a credit cycle, I think bodes well for the future. So I think the other side of, let's call it the tariff determination day, where we truly know what we're dealing with, I think we'll see India do better. Now, so just briefly on the rest of Asia, and I'm not saying much about Japan today because I think it's one that you can read a lot about. But again, a country that is getting back to more normality, that I think they would have liked to see an inflation rate of 2, not 3, because that has pressured the central bank to potentially increase interest rates at a time they don't really want to do it. But the corporate change is massive. The level of share buybacks, the level of corporate governance that we're seeing is still continuing to create benefits. Those benefits are also percolating down in wage growth, which is helping consumer spending. Korea and Taiwan, I would bracket together, clearly tech beneficiaries, but the Korea political change we've seen in just recent weeks will allow the bills that were put in place for a transformation of the corporate sector to now see the light of day. So I think Korea could be one of the big pleasant surprises of coming quarters. And in Taiwan, the tech cycle has been strong. Indonesia, I think we were worried about some of the political changes. It's still an economy that's going to be growing between 4.5%, 5%. Probably not at the 5% level. I'd put more on the 4.7. But the government has been more supportive despite worries about the politics. They've introduced a bill which is putting $1.5 billion into the economy and helping short-term consumption. So saying we are here in support whilst we work our way through the tariffs. And I don't need to say too much about Singapore. You know it. I would just say from afar, one of the best speeches made by any politician about how to handle the tariff situation was made by your own leadership. The economy, though, will struggle to grow. It will go through its weak phases, and we are talking about modest growth rates of 1.5, around 1.5%, and inflation, which again is very modest. No pressure on the currency, but not really going very far. So Singapore will find its way through this. It will still be relatively intact. Unemployment will remain relatively low. Interest rates will remain relatively low, and it's still a place that people see as one of the key centers for doing business in Asia. So I put in my note, this is a region in transition. The stimulus of the nasty policies from the US presidency have pushed people into life. They have pushed people to make changes that they perhaps should have done years ago. And that consensus that we need to change and do things that are positive for the country, positive for the markets, I think bodes well for the day after, as I said, we know what the true challenge is from tariffs.
Good. Gary, that's great. Again, pretty positive. Yes.
Yes, I've remembered so.
Which I like because at the Raffles Crew we are positive. Just a note, folks. It's good to see you. It's good to see Michael Grundy, or at least to see that you're here, Mike, in Hong Kong, and others who've just joined us. The protocol here is that we get prepared remarks from each of our speakers. So Tony, if you're ready, I'll call on you in a minute. Bill Padfield will go third. And then we have Q&A for as long as we need it. Can I encourage people to put any questions that they might have in the chat? Obviously, Gary's summation of the region was really great, but there are many, many countries in the region, and you may have specific questions that you want to drill into. So feel free to pop those questions into the chat. Without further ado, I introduce Tony Nash, who's joining us now from Houston in Texas.
The energy capital of the world, Simon.
Okay.
Hey guys, it's great to join you. Before we start, since everyone else has kind of said what they do, I do two things. First, I run a company called Complete Intelligence. We're an AI-driven platform that helps corporate finance with data validation and automation of corporate finance activities. The other thing I do is called Cloak and Dagger, and it's a geopolitical website where we put in daily geopolitical analysis. Kind of counter, not really counter, but it's in addition to kind of what you typically read in the FT or other newspapers. A little bit, I think, better informed. Let me talk through a few things. Pardon me. First, I'm going to talk through the U.S. economy, U.S. politics. I'm going to get into trade a little bit, and then I'll get into kind of U.S. activities in other parts of the world, and we'll land on Asia ultimately. So the first thing that I think is interesting is we saw a CPI report, a consumer price inflation report yesterday that was very much in line with what I had expected. We're not seeing trade-induced inflation in the US. In fact, it's going the other way. Inflation is trending down. It's trended down all year. This was the fourth report where we saw inflation trending down. So we hear from traditional economists and think tanks and all sorts of other people that we're going to see this inflation looming on the horizon, and it's kind of the opposite of the inflation is transitory discussion that the Fed and others tried to perpetuate 3-4 years ago. It's the opposite in as much as we keep hearing we're going to see trade-induced or tariff-induced inflation, and it's just not there. So whenever people talk about that, I say, hey, is that tariff-induced inflation in the room with us now? Because it's just a non-issue for us. In the May data, if we take out shelter, we actually saw deflation in the U.S. In May. We're starting to see, and as we saw yesterday, equities were down a bit, and so equities are starting to realize that the U.S. needs a rate cut because inflation is nowhere near the expectations. Where in fact we're coming down from 3% in kind of late Q4 to 2.2, I think, yesterday. So 2.3, I think, a couple weeks ago, actually. And so we're going to have 2.5% inflation for the first half of the year, which is what we've expected for a long time. And it's going to continue trending down in the second half. So inflation is just really one indicator. So what it indicates is price weakness. And um, we have to be aware that the inflation numbers are telling us that we're going to see price weakness and that we are seeing price weakness, and that's an indicator of demand. So if people aren't buying as much stuff, prices are going down, and so we see equity markets all-time highs. But valuations are super stretched. It's not as if that's coming in on the back of profits. It's coming in on the back of expanded valuations. Now, when we're seeing that marginal trade, which is setting the valuation, that's largely on the back of retail investors. And American consumers are pretty stretched. So they're effectively gambling in retail investing because they need the cash. Retail investors need the extra cash because we haven't necessarily seen wages over the past few years keep up with inflation. Because of long-term interest rates, we're also seeing the housing market weakening. So this reduces mobility, so people can't move because of jobs or they can't move because their family's growing. It restricts consumers' ability to tap equity credit lines in times of emergencies. So seeing housing markets stagnate is problematic in the same way it is in Singapore. In Singapore we need low interest rates so that we can service our mortgages, and it's the same in the U.S. We also saw over 12% of credit card delinquencies in the U.S. were over 90 days. Sorry, let me say that again. Over 12% of credit card balances were over 90 days delinquent in Q1 of 25. That's up from just over 11%. So again, it's another sign that consumers are stretched. So the Fed knows this, of course. They have something like 400 PhD level economists, so they know this. They choose not to acknowledge it. They were willing to cut in Q3 and Q4 when things were not at this level, but they refuse to do it now. So I'm sure you hear this fable in Asia that the Fed is not political, but the Fed is anything but. The Fed is a very politically driven institution. And so there's a very much a political fight going on in Washington right now to rid the Fed, or I'll say to bring more balance into the Fed so that we can have a monetary policy that can kick in times like now, because they're typically late, probably 12 months plus late in these things. They're already at least 6 months late. They should have kept cutting when they did after the December cut. So let's move on in the US to things like immigration, because I'm sure you're seeing the riots in LA and other places. Unlike 2020, when during the pandemic, and it was an election year and other things, Americans right now generally, and of course there are always elements that don't agree with this, but generally Americans don't have patience for this time around. Imagine in Singapore if people were to overstay their visa. I seriously doubt, having lived there for 15 years, the Singapore government wouldn't put up with it for 2 hours, much less 20, 30 years. Americans don't have patience for this. They're fatigued by immigration. Americans are also fatigued by being kind of ashamed of calling out illegal immigration. It's been quite some time that people have been kind of not able to speak up on this stuff, and it's a problem for the Democrats in the U.S. because shame has become a tool that the Democrats use to stop discussion. And they really, beyond that, they don't really have many tools. And there's a generational change in the Democratic Party right now, and they're trying to figure out what their next generation looks like. So that kind of shame based politicking also extends to places like Australia and Europe. Australia and Europe, although Australia lags quite a bit in terms of kind of the view, Europe is following now in terms of pushing back on immigration and shame-based politicking. Australia will ultimately follow as well because they'll see what happens in the U.S. and just how the political discussion changes as a result of this. Let me also move on to kind of peace talks and what Trump is doing with Russia, Ukraine, what's happening with Iran, and other things. Russia, Ukraine is important for obviously for the human toll, but if we look at inflation in the U.S., inflation didn't really start to bite, and I've got a chart that I show in my typical speech until the month of the Russian invasion of Ukraine. And that's because that invasion drove up a lot of commodity prices. It really constrained supplies in markets. And that's when the Fed also began to raise interest rates. So it's not only kind of the human toll that is important for the Russia-Ukraine talks, it's also the constraints that is placed on market supplies of commodities and other things. So Trump is trying to work on that. I'm not optimistic about it. But I think, again, Americans are really tired of it. I think $400 billion of American money has gone there. And it's proving something that's not really core to U.S. interests. With Iran, it's very interesting to see this Trump visit to the Middle East a month ago. Sorry, Michael Grundy. I would like to understand the basis. Just look at the CPI report yesterday. It's very simple and it's very straightforward.
We're talking specifically about the US, right, Tony? Yeah.
Yeah, US, yeah, about inflation. It's a very straightforward CPI report. I mean, we can go into that detail, but inflation is abating because the data show it. If we look at the Middle East, when Trump visited the Middle East a month ago, he secured, I think, $3 trillion of investment. And I mean, we're not really going to get $3 trillion of investment. That's just a headline. But maybe the US will. But I think that was a generational change in US relations in the Middle East, where the US really doesn't want to get involved in the Middle East anymore. They want to draw down troops and all this stuff. Of course, the largest US base in the region is in Qatar, and there's a very anti-Qatar sentiment in the US right now, and has been for the past few years. That may remain, but Qatar committed to placing $1 trillion in the US for investment over the next probably decade, I think. And I know that Middle Eastern investment funds have been trying to bring huge amounts of money into the US for probably a decade. And that's largely been stopped by the Fed because the Fed hasn't wanted additional money supply in the US to stoke inflation. But that's now kind of quelled, and the Fed is very happy for that money to come in to reinvigorate the U.S., say, manufacturing and services sectors and invest in technology and other things. So, with US Qatar relationships improving, I think that makes a US Iran kind of agreement much more plausible. Because Qatar is to Iran what Hong Kong was traditionally to China. It's a gateway for money, it's a gateway for foreign policy, it's a gateway for other things. And so the US improving relations with Qatar, I think, is a huge step to slowing things down in terms of, say, conflict in the Middle East. So let's move to Asia. So when we look at, say, India, Pakistan, and the conflict there, and the role that the U.S. played in that, was it overstated? Maybe. But what's interesting is both India and Pakistan are emerging as major players in defense exports globally. Pakistan, along with Turkey, is doing a fair bit of drone exports. Of course, Pakistan isn't on the level that Turkey is. India is like Korea, is becoming a major exporter. I would say secondary level exporter of defense technologies. And seeing those two clash, although it was short, seeing them bring out their wares for that conflict, I think was very interesting. And for the U.S. to get involved, I think was a major step because, and I'm going to say something that's probably not politically correct, but
Oh,
his
I think you've already done that
I
quite a
think
bit,
you've
Tony.
already done that.
great, great, bring it on, bring it on. But the US typically has not gotten involved, at least for the last 30 years, has not gotten involved in conflicts in Asia. And the the getting involved in the India-Pakistan conflict, I think, is a huge step forward to showing the US commitment to, first of all, building a relationship with India, but also to step forward in Asia and to get involved in conflicts there. I think the most aggressive statement there was in the past 30 years, probably was Hillary Clinton speaking up at the ASEAN Forum, I think in 2009 or 2010, about the South China Sea, but there really was not a lot of follow through after that. So this kind of is an example of the U.S. getting involved and being happy to be involved in Asia. When we look at China, I'm going to disagree with my friend Gary on China. China still has massive real estate issues that they haven't resolved. Chinese companies still require massive subsidies to operate, Chinese state-owned entities. China still has incredibly large trade barriers to foreign technology, to foreign investment, to other things in terms of ownership of those companies, local ownership of those companies, regulation of goods coming into China, subsidies of things like automotive exports, and so on. So, with China, obviously it's an old statement that China needs more of a consumer-based economy to move into the next generation. That's not going to happen. Communism requires control of the economy, and so this is where when we circle back to trade. I don't believe we're going to have a trade agreement with China. I believe we'll have, like what was announced this week, there's a framework. Okay. So we're approaching, and I developed a trade framework for one of the Asian countries for one of their FTAs.
Okay.
A framework is simply the guidelines for dialogue. So there was a big ambiguous meeting in Geneva. We developed a framework on Monday or Tuesday. I can't remember what day it was. And now we're going to move forward. We will probably not have tangible progress until August. We've said on Cloak and Dagger, we've said since election night that Xi Jinping and the CCP leadership would, for domestic reasons, they cannot be seen to align with the Trump administration for at least 6 months. And both sides need to.
Okay.
Oh, sorry, go ahead.
Yeah, Tony, but this is really good, and quite a few people are itching to rebut some of the things that you're saying.
Great.
In
I
the
can't wait.
in the interest of letting Bill, who needs an opportunity to speak, perhaps you could pass the baton in the next minute or two. Yeah.
Sure. Go on. Look, I think the U.S.-China trade talks will probably last 2 years. But there will be no big bang announcement over the summer. It'll be kind of positioned as that, but the trade talks have to go on, and we have to have China as an antagonist for the midterm fundraising in the U.S.
Okay.
So we'll have some announcements in August so that money will be in people's pockets for the Mid-Autumn Festival. We'll have some announcements so that holiday imports in the US are not disturbed, but there will be no ongoing trade agreement between the US and China
Okay.
for at least a year.
Wow. Okay. Tony, thank you very much. I think a number of you probably noticed Tony has quite conservative views, as do I, and it's not an accident that both of us have been suspended from time to time from speaking on the BBC, which, as you know, is far to the left of us. But we're back. That's the important thing. Bill, over to you.
The 2025 context in Asia Pacific, I just want to look through a couple of lenses here, one of which is founders and the other is funders, which is two of the, I guess, focus areas of Raffles Group. So I really wanted to keep away from the macroeconomic side of it because you've already covered that. I wanted to touch on the where are we looking at navigating this capital constrained marketplace right now. So, and this is all in the context of Southeast Asia. This is playing out on the ground. This is no high level academic view. This is just on the ground right now. So, so the two lens structure looks at how are macro shifts felt inside a startup right now, particularly a tech startup, but also if you were looking through the lens of a venture capital investment committee, in other words, where should we invest, what's next, and so on. So the first one is the reality at 25 for founders, there's massive pressure. There's pivots where people are moving into new markets, new areas, and there's a huge dose of pragmatism sweeping across this part of the world. The fundraising cycles for early stage companies are getting longer and longer. Due diligence is dragging this out from three months to 6 months now easily, and flat rounds are happening. In other words, you've gone through a funding round at certain valuation for your company. Here we are, n many months later, and now you're having to take a similar valuation for the next round, which is something startups never wanted to do. And in certain cases, they're even doing down rounds, which is very unfortunate. So also internal bridges, which is where existing investors are putting some more money in because it's too hard to attract new investors. The implications of this, it's a revenue first mindset at the moment. Got to grow, 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 no question. And a real pause inside of these founders' companies on non-core hires, expansions, and so on, because they really are being scrutinized from the expense level. So the tactical shift we're seeing at the moment is venture debt is still big. It was big in 24, 25. So raising new capital through debt rather than equity. Safe notes, which I'll touch on in a moment, and rolling over safe notes. Fractional executives, which is great for my organization, is in demand because these companies can't afford to hire permanent staff. They can't attract permanent staff. And they're using equity-based compensation to fund either companies like us or individuals. So the advice to founders right now is your deck needs to be a dashboard, not a dream board. In other words, show metrics, show numbers to your investors, to your team, to your board. Don't show them visions and things that you might have done 4 or 5 years ago to get funding. Keep those updates flowing, that you really are hitting your numbers, hitting your milestones, and sharpen your differentiation. So from a funder point of view, it's all about caution. If you're sitting on dry powder right now, not sure we want to commit it. Raising money is harder than normal. They're very risk aware in the funders right now, and they're deploying capital at slower rates than normal by far, in fact. The LP or limited partners that write the checks to put into these funds are still not writing new checks. There's a number of funds that have approached us this year, quite a sizable number, saying, can you help us raise money into our funds, which is something we don't do. But it is delaying exits. And we've had a few other areas of concern in this part of the world. Companies like eFisheries in Indonesia, which got to a valuation of 1.3, 1.4 billion US, and then announced that it was fraudulent. So that's meant that this neighborhood has been particularly under scrutiny from an investment point of view as well. And as far as, international investors outside of the region, they see Singapore, they see Indonesia, they see Thailand all in the same tone, I'm afraid. Current behavior, portfolio support over new bets. In other words, focus down on those investments you've already made, get them to perform. And capital light models are preferred. They don't want to give money to companies that's going to turn it into CapEx, that's going to give a return over a lot of years. They want to see quick returns, focus on product development, sales, and marketing. So the emerging strategies, syndicates getting together to share risk, operator diligence, really making sure that the businesses are optimized for performance, convertible notes rather than equity right now, which means that safe notes, which are, for those of you who don't know, simple agreements for future equity. This is cash now, and we will give you a discount on equity in the future if certain milestones are met. And the advice to funders at the moment is, as a funding company or a venture capital fund, private equity fund, is, are we backing startups or are we actually building companies? And that's the difference right now. It's all about building companies, where in the past it was almost a spray and pray strategy. So they're prioritizing resilience, not trends, even though there are certain trends at the moment, particularly in things like AI infrastructure and things like that. But it's all about lean companies with good expertise. So final slide, quick summary: founders survive, smart, scale lean. Funders combine capital and support. In other words, put expertise in either through yourself or through companies like us. But whatever it is, get that expertise to get performance from your existing investors. The call to action here for founders, of course, is treat investors as partners. Find those funds that really can work with you for the future, not just give you a check. And from funders' point of view, really help those startups win with capabilities and resources. You've really got to spend more time on it now. You can't just put a check in and expect returns in 5 years. So to me, this part of the cycle in Asia Pacific, looking forward over the next half of the year, it's a cycle of discipline. It's about really doing good things rather than despair. And I learned a long, long time ago on a flight from Boston to London, when we were all in the mini computer industry years ago, was companies do their best things in their worst times and the worst things in their best times. Now it's the worst times. These guys have got to perform efficiently, and you'll probably see a new wave of companies coming out leaner and smarter as a result of it. So it's all about adaptation, and that will lead to market leadership. Thanks, Simon.
Thanks, Bill. Many people didn't hear your initial description. Would you like to just say a sentence about Salamander Associates and what you?
Yeah, sure. I was the CEO of an SGX listed company here, and ended up getting acquired and ended up on the board of NTT Inc. in Japan, which is a very interesting experience for a Westerner. And now I'm on the board of various tech companies, but realized there was a gap between venture capital, private capital funding, and early stage tech companies, where they didn't have those experienced resources that have done this more than once. They know how to exit, they know how to scale. So I built a team over the last few months. There's now 50 of us in 14 countries, where we provide services on a fractional basis to help these companies, normally post-funding, once they've got funding, how to really optimize it. And our channel to markets either through the private capital funds or directly to the tech companies. And then sometimes we do pre-funding to help companies raise capital. So that's it, Simon. Thank you.
Thanks, Bill. That's great. And, that's great analysis. Do come to our event on the 23rd and meet Bill, who has a particularly current deep perspective on what's going on in the startup community here. I know a number of you are involved in startups, and certainly in the Raffles Crew, of our 300 members, about 30% are involved in startups, we think. In fact, we're just coming to terms with that. So thanks to our panelists, three panelists, three very different perspectives there, which is great. It's exactly what we want. Can I just gently, lovingly point out that we still have three Dalvin Gills in our audience? Particularly for the ones we can see is fine, but the ones we can't see, could you perhaps just go to your three little dots in the top right hand corner of your screen and go to rename, which is the last thing, and then write what your actual name is so we know who you are. Alternatively, turn your camera on. So that's great. So just please now feel free. The room is open for questions. Gregory, you had a question about whether a credit card debt was going to find its way towards the broader banking economy, I think. Do you want to ask that question? I assume that was for Gary.
Yeah, Gary, just so I was interested in your credit card defaults positioning, and sounds like that is slightly higher. Will that flow through towards the end of the year, I should imagine, and banks' results usually end of the year?
Yeah, I think it was Tony's comment.
Oh, was it? Oh, I got that wrong.
Yeah.
Sorry.
That's all right. Yeah, of course it will. Those banks that hold credit card debt and extend credit card debt, yeah, that likely is a problem unless we see some sort of support from the Fed to allow that debt to be rolled over until rates are lower or other things. But it will, without doubt, it will fold into relevant bank results.
Thank you. Thank you very much. Thanks for the question, Greg. Thanks, Tony. Other questions?
Sorry, I think just to add to what Tony was saying, one element of the this credit cycle, which has got exacerbated by government policy, has been the ending of Biden's moratorium on student debt. That has added a lot again. So for the banks, they'll be facing. Well, I suppose those students have also got credit cards. So, but yeah, there is a bit of a debt problem building up.
Okay, because students. Okay, Mike Grundy, who is a very active angel among other things. Welcome, Mike. What's your question?
Well, I just want to go back on I think what Tony said about inflation, because I was a little bit surprised. So I just looked it up. So April inflation was running at 2.3%. It rose to 2.4% in May. The increase was less than expected because fuel prices came down. So food prices went up, fuel prices came down, but overall it still went up. And I'm just reading here. However, President Trump's tariff policy is likely to cause re-acceleration of inflation in the coming months, economists have said. So Tony seems to be very optimistic here.
That's actually not what we're seeing. And we have to look at who those economists are. So when I hear a journalist say economists said, keep in mind, I've run two of the largest groups of economists outside of banks in the world, at The Economist and at IHS. So I'm a little bit at times doubtful when I hear the words economists said.
So you're saying that economists are politicized, Tony?
Absolutely, yes.
Okay.
Yeah, but okay, I get that, but the facts are the facts. And the inflation went up from 2.3 to 2.4. So the future, yeah, I understand that's to be debated. Maybe we come back in a month and see what it is.
But it didn't, Michael. The most recent inflation result was 2.3%. And when we look at CPI, but when we look at CPI, which came out yesterday, and I would challenge you to look into those CPI numbers. Yeah. It actually shows that now inflation and CPI are two different numbers.
Yeah.
So I would, challenge you to look into those CPI data that just came out yesterday.
Mm-hmm. Okay. Maybe we should let's move on. And just an observation. This is not the first time we've had tariffs. Trump put tariffs in the early part of his first term, and again there was a lot of rhetoric around how that was going to cause massive inflation. That didn't happen. So I would just make that observation that empirically those two things, it's constantly being argued that those two things are directly linked, but actually the empirical evidence does not actually support that view. Okay, any other questions? Do turn your cameras on, folks.
Simon?
Yeah.
Yeah, I've got a question. Where the
Okay.
hell did you get that shirt?
Yes, I know. Well, I can put you onto my shirt supplier if you like. You can't buy psychedelic drugs in Singapore, but you can buy shirts like this, which is a approximate substitution, as we say. Um, well, you can, but you get executed. Um, any other questions? Joanne, you just turned your camera on. Are you going to ask a question?
Oh, I just turned it on because I wanted to, say hi and be here. I was sorry I was doing some running while I was listening. So now I'm done. So I guess I don't have a question, but I'm quite interested to know someone made a comment about student loans. I kind of agree, but I also heard a topic recently about how if you continue Biden's plans on student loans, it might unlock a certain demographics' ability to buy housing and put into more assets and not be kind of stuck. So, which might unlock more potential buying power. So, any ideas? Just something I heard recently.
Yeah, well, the answer is yes, it would have done, but it's not there anymore. I mean, the debt forgiveness has ended, and therefore the students are getting into financial difficulties. So, and that is adding to I don't say mountain of debt. I forget the proportions because I read the details a couple of weeks ago. But all we've done is we've just taken away one of the things that was stopping the debt from rising. As Tony has already articulated, the credit card ones, are at a frightening level. And again, kind of not being recognized. We're not talking about the kind of financial crisis, but we're talking about building blocks that take us through a bit of a crisis amongst the banks in terms of the write-downs they're going to have to take, whether it's the student loans, which I'm not saying came from left field. It was always Trump was going to push back on that. We always knew that. But quietly, at the end of the day, I think it's a more macro factor is that people, quite frankly, feel that they're not being paid enough to live at a basic level, and therefore are using the credit card and every other source of extra work or whatever in order to get their salaries up to a level which give them that what they call a living wage in the UK. And as we look forward, again, this pressure, if these tariffs start to push through, but there is no inflation, someone's going to have to pay for it, and it's going to come off corporate margins. If it comes off corporate margins, then we get unemployment. But the imbalance here is that the labor force has not got enough income to satiate the capitalism that keep asking for extra returns with higher prices. So the balance has got to be struck sometime. And maybe the safety valve is that there's a cut in interest rates, which means that we're not paying so much for our mortgages. But again, the problem in the US is that people have got very long dated mortgages, and it takes a long time for cuts in interest rates to actually help a mortgage cycle. It might help immediately in terms of your credit card bills, but credit card interest rates don't really come down particularly quickly even when interest rates are cut. So it's an imbalance that I don't know the solution for.
Okay. Uncharacteristically gloomy there, Gary. Thanks for that.
Gary, Shantanu here, just picking up on what you said, means I'll be interested to know where then is money flowing, because tech companies are the ones where most of the money flow is happening with investment in AI and productivity getting driven, even margins in tech companies being higher. How is money flowing into a real economy other than consumption, right? Because at the end of the day, if money is not flowing into real economy, there won't be higher money with people for consumption as well.
Yeah, there's different pockets. I have to say, what we heard about call it private equity venture capital space, really does resonate with my own practical experience of what I'm seeing. That the delays in people getting money out of the schemes they invested in before, the poorer returns that are coming through in terms of vintages, as I would say, it's kind of frozen over, and that's a worry. Because if you look at the great growth periods, they're often where sometimes you've got a bit too much money around and it gets wasted. But it's when good ideas get funded comfortably and people remain committed. I have my own experience with my own funder who, basically says, I'll give you, say, 3 units, and ended by just saying, I'll give you 1, basically, because they're just losing confidence in the world and they're trying to conserve their own cash. So we have that trap at the moment, and that's why I'm kind of
What kind
sympathetic
of
to what
fund? Sorry,
Tony.
Gary. What kind of funders are those? Those are equity funders, are
Those are equity funders, yeah. I
they?
mean, yeah, again, everyone, yeah, you can say you can get your venture debt, but as a company, do you really want to take on the debt when you've got at least a consensus view that we need higher interest rates because we've got more inflation around the world? So yeah, some of the sources of how do we get an economy lifting its growth rates from here, they are drying up. The consumer side, though, as I said, in general across Asia, is being encouraged by governments. Fiscal policy outside of the United States can be more relaxed because their debt to equity ratios are nowhere near where the United States are, again, in general. So there is some support for consumption. And that support is coming because of a couple of years here where inflation has been very high and has taken the real spending power away from the consumer and households.
Okay.
Okay, thank you.
Bill, your point was that investors are sharing the risk and going into syndicates rather than taking risks themselves.
Well, there's two things. One of which is the overall money supply, where LPs are or limited partners that writes the checks for a lot of these funds, of which I am one, are saying, look, I can leave my money in the bank right now and I can get 6 whatever percent quite safely. The IPO market's not terribly exciting at the other end. So, I think I'll watch and wait. And of course, watching and waiting is the worst thing that these guys can do. Now, some of those funds that have had exceptional exits over the last 2-3 years are actually getting funding, but there's quite a number of others who don't really have a decent investment thesis, or they haven't had the track record. It's drying up very, very quickly, and I can understand why. Where if interest rates suddenly come down again, which I don't suspect they will in the short term, but if they do, then of course the money supply will open up again and things will start to change. But those funds that are sitting on dry powder at the moment are being very, very cautious about committing it. Now, that's good for them, but it's not good for the LPs, because the LPs actually write checks to put into these funds to commit it in investments to get returns. So the whole thing is kind of out of sync right now, and it just means as a as a founder right now, it's incredibly hard to raise capital. And of course, the venture debt guys working on the other side of the coin, interest rates are high, so they're making out like bandits. But they take a decent risk on behalf of it, are saying, look, take money from us. It's non-dilutive, protect your equity and so on. So their sales pitch is actually resonating, unfortunately. But it's only in future when these guys realize they got to make the payments on this stuff, and all of a sudden that becomes a problem. So it's causing huge discipline within the founders at the moment to optimize expenses, work on margins, get cash flow forecasts the right way, and extend.
That's good for the fractional. That's good for the fractional CFO business, I guess.
Well, it's marvelous for us because these guys, and this is the VC term, not mine, these guys need adults in the room, which means all of a sudden they have to worry about this rather than just picking up another check in 3 months' time.
Well, they're gonna be a lot of these guys in the room on the 23rd of June. So I look forward to you telling them that.
With pleasure. It's their tool, not mine.
And that reminds me of something that Mike Grundy said to me. Mike, because I know you're there. I know you're an angel. You got your hand up. Basic financial discipline, like having a cash flow and stuff like that. You're saying it's very often lacking when you go to invest in a business.
Can I jump in here, Simon, for a minute? Because I run an AI company that's funded, and there's a question about AI investments. And what we saw in the first generation of, I'll say the second generation of kind of generative AI investments. Originally, we saw kind of open AI and these sorts of things move. Then in, say, 2022, 23, we saw all of these quote unquote generative AI companies come about. And to be honest, they're simply APIs into ChatGPT with the front end. And I think a lot of investors have become very skeptical of generative AI plays because they are simply APIs that are tapping into Google Gemini or ChatGPT or something else with a pretty cool front end. And all that means is that that business will be cannibalized by OpenAI or Google or something in the future. So we have seen more concentration in the core AI companies, like more on XAI, more on ChatGPT, and those types of companies. But kind of the apps that gained from the first generation, that's not a play that I'm seeing much activity in anymore.
I'm sorry, but this has shocked the crap out of me because I actually have to agree with Tony.
He's bound to get.
I was at an incubator here with one of the universities a couple of months ago, and 30 companies presented. 29 of them were AI companies, and nearly all of them were, topping and tailing and so on. So to me, the area which I touched on earlier, which has still got legs, I believe, is the whole AI infrastructure world, which is the compute infrastructure, the high performance chip world, servers, clusters, data engineering tools, all this good stuff, which in the old days of the gold mine, this is the picks and shovel stuff. So yes, there's absolutely a lot of, veneer over some existing very, very smart frameworks or neural network models that all of a sudden have got a new user interface and, hey, I'm a brand new tech company. No, not so much.
Okay. Mike Grundy, you did have your hand up. Do you still have a question?
Yeah, so I was just going to change the subject because I just wanted to get some views on what people thought about the American debt and Mr. Trump's new bill. Should we be concerned? Do you think the dollar will weaken? Particularly the dollar strength is important to me.
Can I take that? Because I wrote a piece on
should.
the impact of the bill. So
Yeah.
I wrote a piece for Cloak and Dagger, and I can send the link to Simon if you want to put it out, or I'll try to find it.
I love your stuff on Cloak and Dagger, and it's such a great name for a site.
Yeah, thank you.
Yeah.
But what you're hearing about this bill is that it'll add $5 trillion to U.S. debt. And the reality is, so whenever this type of analysis is done, it's done using what are called economic multipliers. And the economic multipliers for the highest visibility analysis of this bill, they've taken, and I may be off on this, it's all documented in my piece. They've taken the revenue multiplier and they've reduced it by, I think, 50%. And they've taken the cost multiplier and I think it's like 1.6 times the normal cost. So in my analysis, I look through peer-reviewed multipliers for this type of bill compared to, say, the Deutsche Bank and the supposed nonpartisan tax think tanks that do this analysis. And it's really gymnastics to get to the numbers that they're pushing out. And having run large economics businesses or teams, whenever somebody is looking for an economic impact study, or an index, it is 100% a lobbying tool. Okay, so I'll send that link to.
So
Simon.
you don't believe the data, basically.
No, it's not. It's not real. It's not real analysis. It's politically driven analysis. Now, the dollar is not, although in some ways it's related to that, but in other ways it's not. And so we have to look at where the DXY was trading when Trump left office. DXY was at 91 when Trump left office. Okay. Now, when we look at the way Janet Yellen contorted the Treasury General account and selling bonds under her reign, she was toward the end of her reign, she was selling very short-term debt in order to fund the government. Now, the US government has duration risk right now, and they're trying to replace that very short-term debt that Janet Yellen sold with longer-term debt, which is why you see pressure on 10 and 30-year yields right now. So we're likely to see the dollar fall to where where it was, or near closer to where it was when Trump left office. We're thinking 93 on the DXY, something like that,
Okay.
because we will have to see more accommodative stance for that duration risk to be taken out.
All right. Thanks, Tony. That was a very, very detailed answer. Gregory Liddington, you've sent up balloons, you've sent up thumbs ups. How do you? I know you're quite an expert on these things. Do you want to comment on anything that you've heard? Unmute yourself and tell us what you think.
I'm desperately interested in the AI story and 100% following and understand the comments. And I was rather hoping we would see some innovation down here of the next step, maybe something a veneer wrapper around some of the, I don't know, clever hardware or infrastructure. But I would have thought that would have been coming to the market down here. But I'm surprised.
Are you saying there's not enough tangible AI stuff coming out? Is that what you're saying?
No, I would have thought the money. So I'm interested in Bill's comment, but I would have thought the money was here, and they would be looking for that innovation down here with the one with the capital, and two with the quality of some of the engineers that we got down here. But it sounds like we're just seeing Me Too products coming to market is what I'm understanding.
At the moment, there seems to be a lot of focus still on fintech in Australia. There's an awful lot of good investments there, but I agree with you, Gregory. The capital's definitely there. It's just being deployed cautiously.
There's a we had. I mean, this is a slightly tangential issue, but nonetheless very core to Raffles Crew concerns. We have a constituency of people who are between things or are under job pressure and have to pivot to something else. And one of the things that came out actually from a NUS professor was that there is going to be significant further impact from AI on jobs, which is likely to put further pressure, particularly on the older employee who's likely to suffer disproportionately from that. So our follow-up panel is going to look specifically at that. I know that's a slightly esoteric question, but is the adoption of AI going to fall more heavily on the older worker?
No doubt. And we're only seeing the first 1 to 2% of this. And this is with Gen AI. But when we get to AGI and ASI, the next waves of this thing, it's going to be massively disruptive from basic employment. So, we're all looking at this in a very interesting way. And questions I've asked lots of CEOs, different companies is AI or Gen AI an internet moment, or is it just another tool in the toolbox? And to me, this is above and beyond an internet moment. This is massive. So we're already seeing those redundancies. And when you see even companies like McKinsey, who have been working through a process of centralizing everything they can to teach a huge large language model, all of its experience projects, and now have started laying off 10% of their staff to start with and further cuts to come. When you see those massive companies starting to cut back, you can imagine that all the basic industry businesses are going to cut back at a huge wave.
So you're saying, sorry, McKinsey are using large language models to deliver their consulting products?
Yeah, because now you don't need the students to prepare anything. You don't need those people at the bottom of the pyramid that were always fulfilling the operational work, as you know, if you work,
and delivering the largest margins
and delivering the margins, exactly. Yeah. But now you could put it all into an LLM, and you can not only work on a project, but you can actually sit down with the client, define everything, and give them the answer to it in the same meeting.
Yeah. Can I add to that? Sorry, I'm dealing with a law firm at the moment, and that's exactly what they're saying. The requirement for junior solicitors to come in doing the research and basic work is no longer necessary.
100%. And of course, that's now flooding back to the universities where these management consultants, big law practices, banks were picking up all these people. Now they're saying we don't need them. So what are these guys going to do? And if the universities don't pivot rapidly to make more approachable skills, I'm afraid I'm sitting in the camp of those that believes that university degrees may be, irrelevant in the next few years.
So what skills should they be pivoting to? I assume you're not talking about Latin. Bill?
I don't know how many minutes it would teach an LLM to teach it Latin.
Actually, I know
That
somebody
long.
at NUS who's working on exactly that.
Yeah, well, okay, maybe for medicine or something like that, it's still relevant. But AGI or artificial general intelligence, which is the next wave, which will be with us probably 18 months, 2 years from now, it's going to have way, way more levels of intelligence. We are using the basics at the moment, and as we know, we have things that these things will have hallucinations, produce results
Yeah.
which are sometimes insane, but this stuff is being removed. And these self-repairing models, self-optimizing models are starting to come through already. And so the basic, simplest prediction is that you have smart people in the room with this tool in your pocket right now, but soon you'll be able to have the smartest people in the world on any topic in your pocket over the next year or so. So we need to make sure that we are, right now the industry's short of prompt engineers and all this basic stuff. But in the near future, we're going to have to relearn where we as humans, add value in this process. And that's the struggle that universities are going to face.
Okay. Leroy, we'll come to you in a moment. We have a question from David Coldry, who put his hand up. David, where are you?
Yep. Hi. So it's a question for Tony. So we talk about the sort of finances of the US government, but what does the finances of the Chinese government look like? Because they're still spending lots of money. Can they carry on doing it, or do they have a bottomless pit, or what?
Bad and no. I mean, look, the Chinese government is they still have major real estate issues to contend with. They have highly inefficient state-owned entities. Interest rates there are close to zero, and we heard Gary talk about the fact that the central government is actually subsidizing purchases when people go out. So in order to get people to go out and do stuff, go to a restaurant or whatever, the government has to pay 25% of that bill, which how long can that last? So as long as you have a closed account and the currency doesn't trade internationally, you can do that for a long time because you're effectively using monopoly money. But if you have to subsidize going out by 25%, it tells me there are major problems there. Now, that type of stimulus is not like the stimulus they had in, say, 2009 or 2010 when China was funding things like folks in the countryside buying a car or refrigerator or something like that, because those were hard goods, right? But when you're subsidizing meals out and entertainment, it evaporates very quickly, right? There's very little payback for that. And the service jobs that it supports are relatively low paid service jobs.
I mean,
So go
yeah.
ahead.
No, I mean, 25 years ago when I joined Accenture, we were involved in a number of projects in China to kind of take state-owned enterprises and turn them into money-making capitalist enterprises. And the characteristic of the communist economy then was that the government basically determined what was spent and who spent what and what it was spent on. And it sounds as though they're kind of going back to that, which is that the government says what money will be spent on what. And that they're increasingly doing that in order to keep the economy going, which, of course, apart from being a bit desperate, significantly increases the influence of the government on what's happening in the economy, and what's approved of and what's not approved of.
Yeah, the problem is the Chinese economy is brittle, right? Central planning makes a brittle economy. And so it's very difficult for a brittle economy to contend with, say, open economies. And so the US is slow to learn how to work in, whatever new world China kind of invented in the late 90s, early 2000s in terms of trade. But ultimately, we catch on. And China cannot adjust to a different model because it's so brittle. And so when we look at China and when they have to make major adjustments, look at the early 1960s, look at the late 60s, look at, the late 80s in China. people die when China has to make major adjustments in their economic model, and not just a few people, millions of people.
We have
so very problematic.
Okay. Bill, is this a question from you? So far, US tariffs have been on products, not on services. Do you see additional tariffs emerging? That's a question from me.
That's from me, yeah.
Is that for Tony or anyone?
It's for anybody.
Gary, you go with that one.
Well, to my knowledge, it is only on they call it the physicality as opposed to the service sector. I think actually I think Tony was kind of making the point earlier in his opening remarks about the openness of the Chinese economy, and so the service sector, and I would say particularly financial services, is not something you can just walk in and say, I'm going to put a tariff on you. You basically say you've got to start opening the doors to give us access to these markets,
which they agreed to do under their World Trade Accession Agreement.
They
did, and they
nearly
never came to
decades
pass.
ago, and they've never followed through on it.
And it was a broader question than just China, by the way.
Okay.
So if I could jump in here for quick, and I'm sorry for talking so much, guys, but what this big beautiful bill, one of the things the big beautiful bill is putting together is a tax on remittances out of the U.S. So it's a 3.5% tax on remittances going to other countries from the U.S. And so that is I guess, an indirect tax on services, as that money goes out of the U.S.
Okay, all right. In a minute, I'm going to be asking the main speakers, because time's running out, to do their summations. But we had a question from Joanne. Joanne, do you want to actually ask your question? Because I'm not sure I understand it. Out protein, whatever that is.
Yeah, for sure, no problem. Just because it was related to investment either going up or down. But recently, there's been a pushback on alternative proteins such as cultivated meats, and I believe Florida banned it recently, and I believe 2 other states did. But this is an industry that was heavily invested in around 2020, 2022, and so on, billions of dollars. And the year following was just a fraction of that. And there's just been so much negativity and political, perhaps driven campaigns against it. So I'm just wondering if that's something that you see, because I know it's very CapEx heavy. So I'm just wondering if you see a resurgence in that, because eventually I do think that technology will get there.
I think if I may, just for less than a minute, I think the returns on those types of investments have disappointed, number one. I think number two, the cost to produce these things has far exceeded expectations. And those companies that have been in it not only been whacked by different regulatory changes in different countries, but they've also faced challenges with being accepted in the marketplace in general. So for me, I wouldn't be writing any checks anytime soon into that space for sure. But I think for some of those organizations that have actually got traction out there, their products seem to be reasonable. Some are pivoting into other areas rather than just pure meats and so on. They're actually moving into sauces and different derivative areas. But from my point of view, as an organization that would be running right now looking for funding, it would be a struggle.
David, you had a question. I think we know the answer to this. You were asking whether high-profile assets like high-speed trains are actually able to support themselves financially. I think we know the answer to that, but I'll let Tony answer it if he wants to.
Well, not in California, for sure. And I think
the question was in China, but yeah.
Oh, in China, can they? I mean, we're on such sparse routes by now that it's really hard to justify it. In some cases, you just don't need it. Yeah, you don't need a Concorde to go from, say, Houston to New Orleans or whatever, right? So you don't necessarily need a high-speed rail on some of these routes. And so it's cool technology, and I love it, and I love that Chinese built this stuff out. But I think the real question is marginally, what's the benefit to society, and can it sustain itself? And I think there's a lot of subsidies going forward. And really, the first one that we saw of these was the high-speed rail in Indonesia. That there was a Belt and Road investment, and I'm not sure if that's even operational.
It only goes from Jakarta to Bandung, doesn't it? I mean, it's not
right. It is operational.
Yeah, But
That's a
what
very
ended
short
up happening
distance in
is
terms of the size of Indonesia. I mean, it's
right.
immaterial, really.
The Indonesians didn't want to be responsible for all the costs, so they forced the Chinese government to take an equity stake in it, so that they would have to take part in the maintenance. Only 5% of the cost of that infrastructure takes place during the build phase. 95% of the total cost is over the 30-year lifespan of those assets.
Yeah.
Okay, good. Well, it's 9:20. Sorry, go ahead, David. Yes. Who was that? Somebody else I heard. Okay. It's 9:20. So we've gone down some very interesting rabbit holes. Thanks everyone for a vigorous discussion about a whole range of issues. Some quite worrying things, some quite positive things. I'm going to go around the panel and ask you to spend 2 or 3 minutes just summing up your view based on what's going on in the region and what you think you've heard. Gary, let's start with you.
Yeah, I'd stick to the premise I made when I my opening remarks that there are positives to come out of what have been very challenging environment. As I said, I think individual governments outside of the United States have put policies in place which are generally pro-growth and pro-supportive of their economies. I just wanted to touch on one thing around Trump. I don't really like to get into the whole conversation on this, but Tony was making a point about the size of some of the contracts in the Middle East. The Middle East is the center of the global economy, and so I think it's important what the attitude here is. I think people are getting used to gaming Trump. So when he came here, they gave him everything he wanted to hear. Most of those were MOUs. I hear that people are not interested in honoring them. And in fact, there were some very disparaging comments made prior to this from some of the very senior people at the sovereign wealth funds because they had made big commitments to the US. And then when Trump came in, he basically ripped up lots of those contracts and then was asking to write new ones. So we have to be very careful in this environment of trying to find the middle course. And I'm in the markets, trying to interpret this, and it's all incredibly difficult. But what I don't want to do is I don't want to walk away from what we're seeing and say that this is going to be wholly negative. As I said, my main point is whatever challenges we have, the global economy adapts. The interesting conversation around AI, I think, is great. We all have to adapt to being challenged by the AI and see how we fit in with it rather than it fitting in with us. And making sure that we're all relevant. But growth is good. Maybe inflation is going to come down quicker than we thought, but I still think there's a bit of a spike. But in a year's time, I think we'll be hopefully beyond the worst of this disruption to our lives, and we will know how to cope with it.
Thank you very much, Gary. Tony, can I ask you to focus your summation, if you can, on Asia?
Yeah, sure. So we're in a time of intense change, whether it's geopolitics or markets or technology. And I think Asia has become accustomed to a certain model, and I think that model is changing. And I think what I would recommend is we acknowledge the world we have rather than act like we're in a world that we want. And so you have to look at the conditions and how conditions are changing rather than operate in a world that we wish we had. So just very pragmatic.
That sounds like good advice. Thank you. Thank you for that, Tony. Bill.
Very easy. I would look at capital at the moment is a challenge, but there's good days and there's bad days, and the pendulum will swing back. So the money hasn't gone anywhere. It's still there. It's yet to be committed. And normally when we go through lean cycles, it means that companies gain better discipline and become better as a result of it. So not the worst thing in the world. The second one I would touch on is skills. Talking about Gen AI and various other next phase in the AI journey. Like any other transformation that's happened over the last 40 years that I've been in the tech industry, it's all about keeping ahead on the skills. So no matter how old you are, keep up with the skills. There's some amazing online courses now, even free courses. Just constantly set time aside to keep on top of it. And then it's not threatening. For you, it could be opportunity. And I still love this thing about the Chinese character that's the same on one side as disaster and the other side, it's opportunity. That's the way I see the market right now. I invest according to that. We work with companies according to that. So don't get doom and gloom. There's always opportunities there, but keep your skills up.
I like that. That's very positive. Okay, good. Thanks very much for that. Single out Gary Dugan for particular thanks. Gary, you've been helping us a lot, and you stayed up late to cook your figures, and I really appreciate that. And you've remained relentlessly positive, which suits my general outlook at the moment. So thanks for that. And for those of you who enjoyed this as much as I did, and this has been a great discussion. We will be doing this, I hope, on a regular basis, updating the numbers. And I think one of the things that we're going to try and do in future when we do this. In the future, when we do this, is to drill into specific geographies in a little bit more depth. And on that topic, I have academic experts on, for example, India and China, who are going to be doing a series of seminars for the Raffles Crew in the coming months, because I think you can't really be serious about being invested in Asia if you don't understand at a fundamental level what's going on in those very large and influential economies. And India, of course, has a growing population and will have by far the largest population, in China has exactly the opposite problem. So I think those two areas are very interesting. Lastly, a commercial, the Seekers, Founders and Funders event on the 23rd of June. If you're in Singapore, it's a great event. We're going to have a lot of people in the room. There are going to be a lot of founders and a lot of funders, and there are going to be a lot of interesting, talented people. And we have an army of fashionistas wearing exciting dress from India and Japan that I happen to meet, and they're absolutely amazing. So they'll be wandering about, and it's going to be colourful and beautiful. And when we finished our networking, we've got a jazz band. So think about that. Just above my right shoulder, the QR code. Click on that. I'll leave it up for a bit. It takes you to the PTX sign up. Those of you who haven't signed up for the 23rd, why not join us? So there we are. So thanks, Tony, for joining us from Texas, getting out of bed. You always serve up some stimulating remarks, which upset some people. It's always good to upset some people. People need to be upset.
I try, Simon. Thank you very much. Thanks for the opportunity.
No, you're good. Well, I've heard you do it on the BBC. You've been expertly upsetting the British Broadcasting Corporation for more than a decade now. So my hat off to you. And Bill Padfield. Bill, I can't say, I don't know where you've gone. Bill, you're amazing. I know you're coming on the 23rd, so that's fantastic. But your insights into the entrepreneurial market, particularly in the tech area, are completely amazing. Your remarks about AI are slightly frightening for an old geezer like me. But never mind.
Thanks for the opportunity, Simon. You kept me up past my bedtime, so well done.
Me too, actually. So bless you all. Thanks very much. Everybody, do sign up in future. There'll be more of these. Yes, David, thank you very much. God bless you. Kushla, good to see you. Gregory, good to see you, everybody. See you next time. Oh, and don't forget to come to the coffee tomorrow, Raffles Crew. 9 o'clock, Raffles Place. Yes, Leroy, we haven't seen you for a while. Bless you all.
Thank you.
Bye. Bye-bye. Bye-bye.